to the attorneys, and they really loved it. It touches on a lot of different things that we deal with in the mortgage industry. I've been doing this for 38 years, so I have come into contact with a lot of these things, divorce being the largest one, and we've done the divorce many times now. We've had somebody come in to speak about the divorce, but we're also going to go over conservatorships, probate, and stopping foreclosures, and what type of modifications are available out there to help your customers. So with that, I am going to get us started. Let me just start the custom slideshow. Sorry, guys. From beginning. Last coaching call I had, we were having a problem. So I want to make sure that everybody can see the screen and see the PowerPoint. If you're not seeing it, please let me know.
I could see it.
It's
Okay.
good.
All right, awesome. Thank you. I appreciate that. Why is this giving me such a hard time? Let's put this over here, down here. You see, you can see it, but for some reason I am not seeing it right now. So oh, for the love of peanuts. Hold on a second. Sorry, guys. Now nothing's showing. Geez, Louise. Ah.
It's back again.
Okay, you got it. You see me, right? Okay, sorry about that. Okay, so today we're going to talk about navigating the legal intersections in real estate. So we're going to start out. Most of you know who I am. I've been in the industry for 38 years. I started my career in New York, downstate, Long Island, Manhattan market. And in 2018, I moved here to Colorado Springs. And I saw a lot of different needs for niches here. Where I am is a big military area. And I also, unfortunately, due to the fact that it is a big military area, it means that also our divorce rate here is about 70%, which is the average divorce rate for the military. So if you are trying to create something a little bit different than other loan originators, I always suggest take a look at where you're at and see what you need. You may be in a rural area where you might want to be a specialist in USDA loans. You may be working with first-time home buyers. Whatever it is, try to find your niche and make that your strength. That is something that I've always done when I lived in Manhattan. We had things called co-ops, and I was the co-op queen. Everybody hated co-op loans, and I used to do a lot of co-op loans because Manhattan is an 8-mile island with 5 million people or more probably at this point. And so co-ops are basically old apartment buildings that they transferred, and you buy stock in a company. So not every lender does it, and you may never come across these things. But again, I urge you to always take a look at the area that you're in and find your niche. So we're going to get right into the divorce. We're going to go through this quickly because we have done several trainings on the divorce. But what I wanted to do was focus on the things that attorneys are focusing on on the CLE and the understanding that they're looking for, where you can help. And if you want to make attorneys your niche, I would strongly advise looking at becoming a CDLP, that's a certified divorce lending professional. So as you know, for many going through a divorce, the marital home and other pieces of marital real estate are going to be the largest assets that they have. So whether or not the marital home or real estate should be retained and by whom is often going to be the major issue. So what happens to the family home ultimately is going to depend on the facts of each individual case. So as divorce, almost by definition, is going to suggest, parties are no longer going to want to live together. They're getting divorced for a reason, and so that means that we have to start looking at the division of their real estate and other joint investments that they have. And it doesn't necessarily mean that the parties need to separate their ownership of the marital home immediately. There may be several reasons why they need to delay that. One party may need to collect child support and maintenance. And in our divorce world, in the world of lending, we follow what we call a 636 rule. And that means that you have to receive 6 months of child support and maintenance, and that it needs to go forward for 3 years in order to actually use that as income to qualify. In other cases, parties may want to play the market. They may have a house where they had refinanced it a few years ago at 2.5%. Maybe it's a VA loan. VA loans, most of them start upside down because it's 100% financing, and then they have to fund their funding fee, which is 2.15. So there may not be sufficient equity at the time to do any kind of equity buyout. And all of this is going to be worked out through the attorneys to decide when the best time is to either sell a home or refinance to buy out the other person. So, as you know, during COVID, we had a lot of shortage of housings. There was a lot of bidding wars, and that was common practice. And as I stated before, most borrowers were closing loans in the 2 to 3% area. Home ownership was actually incredibly affordable. In many cases, buying a home and taking on a mortgage was cheaper than renting an apartment. Now, today, the average mortgage payment is between $1,300 and $2,000 more per month than it was during COVID. And we know that the bidding wars did inflate property values. And now, in many areas of the country, what they're experiencing is some declining values, and that's really due to the inflated prices. And of course, inflation has reared its ugly head, and earnings have not increased to keep up with inflation. In many, many areas, insurance and property taxes have increased as much as 40%. And that means that people's mortgage payments are going up significantly due to the fact that they have a shortage in their escrow accounts. So why do I mention all of this when we're looking at divorcing clients? Because they have to qualify for the mortgage. If their insurance went up, we need to see if there's any way to get insurance down. So for example, here where I live in Colorado Springs, we had severe hailstorms last summer. To the tune of each individual house in my neighborhood taking probably $20,000 to $25,000 in damage. My house personally had to replace the roof. I'm still replacing siding and things that were damaged from the hailstorm. And so because of those things, my insurance went up from $2,300 to $3,800 a month. Also, because of the shortage, because of the inflated prices and the bidding wars, the county reassessed our property taxes and assigned us all much higher values on our homes. And again, that made our mortgage payment go up. So when you're going through a divorce, the problem is that you have to qualify not only at today's interest rate to do an equity buyout, but a lot of times the one party is taking on maintenance and child support, which then becomes a liability. And so a lot of times they're not able to qualify. If it's an amicable divorce, this is where attorneys can actually negotiate and say we can do a delayed sale or a delayed financing and give the market time to settle down. So these are all things that attorneys will come to you as a mortgage originator to kind of consult with you on verbiage in the divorce decree, timing of when you should pull the trigger to either refinance, do an equity buyout. The one thing that we do look at with equity buyouts today are HE loans and HELOCs, and we're looking at blended rates. Okay, so let's take a look at a quick case study for an equity buyout. If you are in a position where you're working with divorcing couples, you kind of want to look at both sides. So refinancing or selling. So if they're able to refinance, let's say the mortgage balance is $280,000. Their current pity payment is $1,550 and their current appraised value is $525. So the property value you're going to take, you're going to subtract the mortgage, okay, and you're going to divide that by 2, subtract the closing costs, and then you're going to see what your new pity payment is at today's rate, and which would be 7.5%, thereabouts, okay? So now their mortgage payment's going up to 3,205, but if they do a refinance equity buyout, they are going to have more money in their pocket than if they go to option number 2, where they sell the property. So real estate commission figure, if you do a buyer listing agent, you're looking at 5%, 3% at the bottom. And so, of course, that's going to show a reduction in what that equity buyout is. So we look at doing an equity buyout to be slightly problematic in today's rising interest rate economy. So the person that's remaining in the home now has to go from a mortgage payment that's $1,655, doubling it, all right, to $3,205. So they need to rely on knowing not only if they can afford that payment, but they also have to look at the house itself. What repairs are going to be needed? Do they need a new roof suit? Are they going to need a new furnace? All of these things are things that home buyers are going to be thinking about when it comes to a decision to whether they're going to retain the house or sell it and just go their separate ways. We have several different solutions that we use when we're looking at divorces, okay? So you have assumable mortgages. Our traditional assumable mortgages are going to be FHA, VA, and USDA. Then we have court-ordered loan assumptions. Okay, so what that means is that in the divorce stipulation, it says that spouse number 2 will be retaining the house and taking over all mortgage payments and has to quit claim the deed over and get the other spouse off. Once that court order has been recorded, they have to call their servicing company. They send the servicing company a copy of that court order to show that the court has determined that spouse number 2 is getting the house. And what the servicing company has to do is put the name of the borrower on top, and they are the ones that will be receiving the statements to make the mortgage payments in the future. They cannot call the loan because it is a court order. However, by doing a court order loan assumption, the person, spouse number 1, who is on the mortgage does not come off the mortgage, okay? They're still on the mortgage. So if spouse number 2 pays that mortgage late, it will reflect on the other spouse's credit report. We look at HELOC and blended rates, all right? So that's another thing that we look at. Recently, last year in June, the VA came up with new verbiage that says if there is a court order loan assumption, that they can do a release of liability without doing a loan assumption, meaning that you will have to usually show that spouse number two who got awarded the house has made those mortgage payments from an account not jointly held with the other spouse for 6 months. They have the court order that says the house is theirs and they've quitclaimed the deed. Those are the three major things that you would need to get a loan assumption. Now, why would you help somebody do this? It doesn't put money in your pocket. Well, because the interest rates are so high, by helping people and maintaining a relationship with them and keeping in touch with them, this will be a future refinance because they're going to want to get out of these kind of loans. If they do a court order loan assumption, eventually they will have to refinance because spouse number one wants off of that mortgage. So this is a way to help the community and also pave a way for you to have future income coming in. Now, another thing that we look at when there's a divorce is we look at revocable trusts. So let's say your client is going to be receiving a lump sum payout. Let's say there was a pension. The pension got put in a quadro. A quadro really is a way to protect people from having to pay penalties during a divorce. And then when it's settled, that quadro is released. And then let's say they get a $500,000 buyout. That $500,000 buyout can be put in a trust as long as the trust is not run by the person, but it has to be run by a separate company and they're getting a fixed income. Let's say they get $10,000 per month from that income. If they're getting that for consistently for 12 months, all right, you can use that as income as long as there's 3 years going forward. So you can use revocable trusts. Again, we're looking at the timing. So keep in mind that if there's child support and maintenance, you follow the 636 rule, 6 months of receiving that support, and it must match the mortgage stipulation. All right. And then 3 years going forward, if they're going to do a trust, the trust has to be created, and then we have to show that they've been receiving a year of fixed payments. Now, that's a new Fannie Mae guideline. They used to take one. Freddie Mac is still taking the trust with one payment, but that's on a case-by-case basis. So if you are working with a trust, you need to always consult with the lender that you're going with just to ensure that they have no overlays that they are put in place for trust income. But this is another way to generate income. So when it comes to court orders, verbiage is very, very important. If you decide to work with family law attorneys and divorce attorneys, they are going to rely on you a lot to help them make sure that they have the correct verbiage in those divorce court orders. So if they're getting child support, again, the 636 rule. We are going to want to see the birth dates of all children in those support, in the child support papers. So here in Colorado, if a child receives support, it's automatically until they're the age of 19. In other states, it could be 18. In other states, it could stipulate that the support goes through college. So it has to be spelled out, and we need to know the age of the children because we need to know whether it would be going forward 3 years. So let's say you're in a state like New York, where once the child graduates high school and is at the age of 18, if the child is 15 when you're doing this, there's a good possibility you will not be able to use that portion of the child support. Same thing with maintenance and alimony, okay? It has to be spelled out. Lump sum payouts need to be spelled out. Assignment of debt, this is another thing that's really wonderful when it comes to court orders. They're assigning each person debt. Okay, so if spouse number one is responsible to pay for this car loan because they're getting that car, or they're responsible to pay this credit card, as long as it is put in that stipulation, if they're not able to separate their liabilities or refinance or close them down, the court order is all we need, and we don't have to hit them with that monthly debt. But again, it needs to be spelled out in that stipulation. So any cars, we need the full account numbers, we need the VIN number in there. We need to be able to identify the car with the loan in order to forgive it if we're doing a refinance or a purchase for a spouse that is no longer obligated to make those payments. So that's called a court order assignment, just like the mortgage court order assignment. Any questions? Okay, we're going to continue. Now, probate is another interesting thing. And so we're just going to go through the process. Let's say you're working with somebody, and I hate to say this, but if your career is long enough, this will have happened at least once in your career. You are doing a mortgage for somebody who's buying a house, and the seller of the house passes away. There are certain situations that when the seller of a house passes away, that house then has to go into probate. And it's all going to be on the way that property was vested. So any house that's in a trust, the trust takes over, it becomes a non-revocable trust, but generally speaking, that will save the house from going into probate. If the house is vested and it's like with joint tenancy with rights to survivorship, then the person that survived on there would be able to still continue with the sale of that home. But let's say the property is tenants in severalty, meaning only one person owned that property and they never put it under a trust. This is the things that will happen before that house could ever close. It will have to go into probate. Every state is a little bit different. However, the estate is responsible to notify the lender of the death of that person. And generally speaking, as the heir or executive, they have 30 days to inform the mortgage company. Understand that the mortgage company cannot call the loan, okay? It is protected under the Saint Germain Garn Act, which basically says that you cannot call a loan on a house just because the seller passed away, okay? Again, if it's one person that's inherited the house, they actually can also continue making the mortgage payment under the old spouse's name. But if it's, or the old owner's name, if they're going to be keeping it, if they're going to be selling it, then they have to make the mortgage payment until at such time the house has been sold. Generally speaking, the servicers will require a copy of the death certificate and verification of the inheritance, meaning you'll have to submit the will and or trust or both. Depending on the state, the inheritor may need to go to probate. It's all going to be dependent upon the state that the property is located in. And only one person can be named the executor. So if heirs want to assume the mortgage, federal law will require lenders to allow for such transfers, okay? That's the Garn-St. Germain Act. Heirs have the right to assume that existing mortgage. Again, no due on sale clause to the heirs, and only one qualified heir can assume the mortgage. So if the house is left to four people cannot assume the mortgage. Only one person can assume the mortgage. Any questions? Okay, so let's talk a little bit about the Garn-St. Germain Act, okay? These are the following conditions that need to be met to be protected under this act. The loan must be secured by a residential property with 4 or fewer units, so 1 to 4 units. The deceased person must have been a natural person. So if they are not here under US citizenship, green card, visa, or something like that, then they're not going to be protected under this act either. The loan must have been the loan must have been in place prior to the borrower's death. Okay, and the heir needs to inherit the property from the borrower, and the heir needs to occupy the property as their primary residence. So these are the main things. You might want to take a little picture of this in case you ever come in. It's a nice little cheat sheet. This act was actually passed in 1982, and it was specifically done to stop lenders from calling the loan and foreclosing on properties after somebody had passed away. Especially, we saw a lot of stuff with reverse mortgages, and that's protected under this act as well. And that's why if you have a reverse mortgage, you can't assume that necessarily unless you're of specific age, but they have to give you the right amount of time to go ahead and refinance and get it out of the estate name and into your name or into your mortgage, a regular mortgage. Remember, a reverse mortgage is for people ages 62 and above. So multiple heirs and purchasing. So when you have multiple siblings that are inheriting a house, all of them are going to wind up with a share of that property. So let's say there's 4 people that inherit a house, each one of them gets 25% of that property. Anytime more than one sibling receives a property inheritance, everyone needs to agree on what has to be done. Okay, and regardless of how large or small each sibling's share is of the estate, everybody is entitled to their share. This is where some arguments can come into play. All right. Maybe 3 of the 4 siblings want to sell the property and just be done with it, but maybe the 4th sibling wants to buy the property. So they have several options to choose from. They can refinance to buy out their multiple heirs. Okay, so they can contact the current mortgage servicer. They can review the due on sales clause. Okay, and if the property deed can be transferred without the acceleration clause being activated. They're going to look at how that deed was vested. Is it in a trust? Is it in, is it in an LLC? All of that's going to come into play as how that deed was vested. So what do I mean by vested? Is that if a couple buys a house and they're married, generally speaking, it's joint tenants with the rights of survivorship. If a brother and sister purchase a home, it may be tenants in common, where if one tenant or one owner dies, their share of their property goes to their heirs, not to the person that owns the house. So how a house is vested is always going to be very important. And it's always very important to make sure that during all of this, the mortgage payments are going to continue. If the estate doesn't make those mortgage payments, the bank does have the right to contact the courts and get approval to foreclose on that house. So no mortgage payments does not mean that you get away with anything. They will eventually have to foreclose. In a case like this, we can do what we call a gift of equity purchase. Okay, so what does that mean? That means that each individual has a percentage of the house. So the person that wants to maintain the house can take their 25% and they can use that as the down payment to purchase out the other siblings. And we call that a gift of equity. In other cases, you'll just, oops, sorry about that, guys. In other cases, you may just have to refinance depending upon, again, how it's vested. Okay, so generally speaking, they're going to want to get an appraisal to determine the value of the home. What I will say here, whether this is a probate situation or a divorce situation, they can get an appraisal. They can throw that money out, but the only appraisal that is ever going to count will be the one that is ordered by the lender. So an appraisal will help give them an idea of what the value of the home is. It doesn't necessarily mean that that's what the lender's appraisal is going to come in for. They can draw up a purchase agreement with the estate. And they can use a lender that is actually going to specialize in trust estate loans. So if you work for a mortgage broker, and this is something that you're interested in getting involved in, make sure you have your lenders in place that will work with trust estates. Not everybody wants to do that. Not everybody is equipped to do that because they don't completely have a full understanding. And that also goes with divorce lending. There's many places out there that don't understand divorce lending. Divorce lending is a little bit different, and they have to be able to understand that the court order supersedes a lot of the Fannie Mae, Freddie Mac, FHA guidelines. So just make sure that you have your lenders in place that know how to work with these types of loans. Let's talk a little bit about the reverse mortgage. So if there are no co-borrowers or eligible non-borrowing spouse, the heirs will need to pay that full loan balance to keep the home. Generally, it will be up to a 95% of the value. And that's with any equity buyout too, by the way. If you have a court-ordered equity buyout and the loan to value exceeds 80%, that is still okay. Okay, you can go up to 95% on a limited cash out, provided that the equity buyout is court-ordered. And so same thing would apply to a reverse mortgage after the owners have passed away. You can basically refinance up to 95% of the value of that property. And the lender is going to typically provide the heirs with repayment options, which they have usually 30 days to make a decision. Most lenders are going to give the heirs 6 months with periodic 3-month extensions. Most of them basically will go up to 12 months. Okay. So let's talk about conservatorship since we just spoke about reverse mortgages. So if you have somebody that's keeping a home under a conservatorship, all the mortgage payments, taxes, and insurance have to be made on time. If they're trying to keep that person in the home, let's say they have dementia, okay? And they don't want to leave that home. It would be unhealthy to put them in a nursing home. And the conservatorship decides we're going to take the equity in this house and do a reverse mortgage. This is a possibility. A conservatorship can do a reverse mortgage refinance as long as it's meant to help the person that owns that home. It doesn't mean that the conservatorship owns the home. It means that they are acting in a way to help the actual owner of the home. Does that make sense to you? Okay, so basically conservatorships have exclusive control over the conservatee's affairs. So they have to be able to show that their actions are taken with the best interests of that person in mind. That means that they're going to have to go through the court to get approved if they're going to do a mortgage on the house. And generally speaking, the only mortgage that will pass through is the reverse mortgage. So if you are getting involved in reverse mortgages, again, this is a niche. There's a lot of realtors out there that work with conservatorships. And so this may be a step into the right direction into that type of a niche if you want to work with the reverse mortgage people or generation. So right now, I will be honest with you, reverse mortgages do really well in low interest rate environments. There's more equity that can be pulled out of the house. In interest rate environments where the interest rates are now over 7% or 6.5%, whatever it is, it's based on the age of the person that is doing the reverse mortgage. So in a conservatorship situation, it would be based on the age of the person who's the conservatee, okay? And they're giving less equity. So if the house has a mortgage on it, this may not actually work for them, because most of the time when you're doing a reverse refinance, the reason we're doing it is so that you can bring in home health aides to come in and take care of that person. And so if there's not enough equity, or if there's an existing mortgage, this situation may not necessarily work. So we're going to talk a little bit here about, oops, sorry about that, guys, back and forth, foreclosure and bankruptcy. So after 2008, after the big recession, we had a lot of foreclosures and a lot of bankruptcies going on. And many times you may get bankruptcy papers and you actually see the mortgage on there. Please understand that you cannot have a mortgage forgiven in a bankruptcy. However, if your property is in foreclosure, filing for specific bankruptcies can help stop that foreclosure. So if you have a client that has received a foreclosure notice from their lender, filing bankruptcy is going to give them the best chance to keep their home. But it all depends on how the bankruptcy is filed. So for example, if they file Chapter 13 bankruptcy, this is going to allow the borrower to get back on track by making late payments over time through a loan modification, which would be arranged with their lender or through the court. Okay, so Chapter 13 bankruptcy is going to allow them to keep the house, catch up on the payments, and catch up on everything. It is a repayment bankruptcy, okay? If they choose to file Chapter 7, this is not going to allow the homeowner to get caught up on the mortgage, because this allows people to completely eliminate their unsecured debt. So a mortgage secured by a property can still be foreclosed on. It may delay the foreclosure and give them the opportunity to maybe come up with the money to catch up, but it's not going to stop it forever. Okay. So if your clients are not going to be able to come up with the money to get caught up and bring that mortgage current, then it's very likely that the lender will ask the bankruptcy court to let them proceed with their foreclosure. So if they're going to do a Chapter 7 foreclosure, they can potentially get hard money to save the house, to catch up on that. But in my opinion, and it's just my opinion, okay, doing something like that is really kind of like putting a Band-Aid on a gaping wound, because if they can't afford to make the mortgage payment that they have on the house, going for a hard money loan with those very high interest rates is only going to make that mortgage payment higher. Now, they can always, and you can always reach out to an attorney, to the courts, or to their servicing company and see if they would be willing to do a modification. And if they are, this is the better way to go. You can still do the Chapter 7, work with the servicing company to do the modification. And then once they have caught up on the mortgage payment, you may be able to get them in a credit repair program. But Chapter 7 bankruptcy requires 3 years from discharge before they can do anything, like refinance the house. Chapter 13, you can do 2 years, and generally speaking, that's with the FHA, okay? So these are just like little solutions to help your borrowers. Again, doesn't put money in your pocket right away, but it helps. What I always feel that whenever you're helping somebody, you're kind of paying it forward. They're going to remember that you helped them keep their house. They're going to remember you. And even if they can't use you for a mortgage right away, these are people that will refer you because you helped save their home. All right. So you don't always have to rely on mortgage professionals, realtors, attorneys. Sometimes just by helping other people, you can build your book of business that way as well. Okay, so we went through that. Um, Now, here's something that you might want to pay attention to. We have very low foreclosure rates going on in the country right now. We should all be really, really proud of that. But foreclosures are happening, and in part, it's because that during COVID, lenders were offering homeowners a forbearance option, meaning you don't have to make your mortgage payment as long as we're on lockdown. However, what wasn't understood about that is though the forbearance permitted the homeowner to skip their mortgage payment for whatever period of time it was, whether it was 6 months, a year, um, that didn't stop the interest from accumulating. That payment was then being added to their principal balance. So a lot of people, when COVID was over and they took the forbearance option, ended up owing like $26,000 to the bank, and the banks were like saying, "You have to pay us back this money." We could not do a refinance unless we could show that they were at least making the payments for 6 months. And this forced a lot of people into a situation where they still maybe had not recovered from their job. They're trying to negotiate with their servicer. And, a lot of people didn't really understand how to offer the forbearance or how to advise their borrowers properly. But the thing is that if somebody was in forbearance, um, and their servicing company, and they don't have the money to pay back their mortgage, what they didn't pay on it. If they can buy time, get a modification put together with the servicer, and they make those 6 payments of mortgage payments, then you can step in, refinance the loan for them, and put them in a new loan. But this is where what we're seeing some foreclosures happening because people were not able to come up with the money after the forbearance period was over. Wasn't like our student loans where everything was frozen and they stopped adding interest to it, and they didn't and they were adding the payments to it. Student loans automatically you can renegotiate, but mortgages are a little bit more difficult. So this is again one option for people that were in forbearance. Get that modification, get those 6 payments going so that you can step in, refinance them, and get them out of that situation. We're just going to talk a little bit about staying compliant. Okay, so January 2013, the CFPB actually issued a final rule to amend our Regulation X. So these changes included modifying the servicing transfer notice requirements. RESPA requires lenders and mortgage brokers to provide borrowers with pertinent and timely disclosures regarding the nature and costs of real estate. So when Congress enacted the bankruptcy rule requiring mortgage companies to disclose their fees, this is where bankruptcy attorneys kind of stepped in, reviewed all the documents to see if the lenders were doing their due diligence in notifying people of all the fees that they were going to be charged. And all of these fees had to be disclosed within 6 months of the fee being incurred. So this kind of allows the debtor or borrower to know what fees are going to be assessed. If they don't disclose that, there is a huge loophole for the attorney to step in and save that property, and get those fees waived because they weren't properly disclosed. So when somebody is working in a situation where there's a bankruptcy or foreclosure, they really want to make sure that the lender has followed all the rules to stay compliant. Okay. Attorneys are always going to be looking for loopholes to help save those properties. So RESPA is something that kind of you want to follow a little bit and look and make sure that if you're trying to help somebody, that their servicing company has done the correct thing. So, questions for anybody here?
Sandy, I don't know much about reverse mortgages. Would it ever make sense if someone couldn't get as much cash out as they'd really like to do that reverse now and then maybe refinance when rates come down, or is that not allowed or just not cost effective?
So right now in this environment, Alan, I'm not a huge fan of reverse mortgages for people under the age of 72. They're not going to get it. So you have to look at the age. You also have to look at what they're trying to do. Are they trying to stay in the house indefinitely until they die, or do they need help? So every situation is kind of different. If they own the house and there's a mortgage on it, you got to do the numbers. The numbers are based on their age and equity in the house and what has to be paid off. So I would say that if there is a mortgage on a house and there's only 50% equity in the house and that person is under the age of 72, it absolutely probably won't even make sense. They probably won't be able to get enough money to do that. If the house is free and clear, then any amount is going to make sense because it's done as a HECM. So let's say the house is free and clear and they get approved for a HECM. Let's say the house is worth 500 and they get approved for a $250,000 HECM. They don't have to take any of that money from the HECM right away. And so they might be setting themselves up for, let's say they might know that they are ill, they have issues, and that there's going to be a time where they're going to need to have people come in to take care of them. Then it might make more sense. But it's really, you got to look at what the mortgage is on the property, what the balance is, and what their age is, and what their situation is to kind of determine if it would make sense.
Oh, okay, thanks.
Anybody else? Okay, well, if you don't have any other questions, we're going to end this. This recording will be archived in our library on the new LMS system. In the chat, I put my YouTube channel there. You will see a lot of the special guests. When we have a special guest, I share that with the public on our YouTube channel. All you have to do is click on the link, subscribe. We have about 20 or 25 different videos. Some of them are very short. They'll talk about anti-steering, things that we were doing for COAMP for a while, helpful hints, what to look for. And there you will also find different coaching calls that were sponsored by our guest speakers, such as Patrick, who was the credit repair company. So if you are ever interested in looking at those, just go to the CrimeAt channel. You're going to be contacted today and the next couple of days forward. We are moving everybody over to our new LMS system. And so we're really excited about that because we're going to be able to offer you a lot. So you will be getting a phone call from my business partner, Matt Jelinski, in the next couple of days to get everybody switched over and get you your GHL account. So if there's no more questions, always remember you can come into the mortgage support room. I'll be in there in about 10 minutes. Okay. So happy to help in anything that you guys need. Okay. Have a great day, everybody.